All right. Hi, everyone. Welcome to the real estate panel. Thanks, everyone, for joining us. I think today's going to be a really productive and great conversation. I first want to start things off by thanking Stephanie, the Office of Institutional Advancement, and the PC Real Estate Committee for helping facilitate this event. Thank you for everyone for joining us. As a way of introduction, my name is Andrew Tuccio. I graduated from PC in 2014. I currently work at Gansett Ventures here in Boston as a development manager. Just want to take a quick second here to introduce those of you joining us to the PC Real Estate Committee. This is a group that I started 2 years ago. We bring PC alumni who are working in real estate or aspire to work in real estate together, and we host a number of networking events and industry panels like the one that we're on today throughout the year. We have over 100 members in the group. If anyone's interested, feel free to reach out to join. Everyone here on the panel is an active member of the committee, and I'm very thankful for everyone for joining us today. So with that, I'll give an introduction of who's going to be talking. So first, we have Steve Woelfel. He's a Senior Vice President at Colliers. We have Carolyn Molloy. She's a Senior Associate at Lincoln Property Group. We have Jeff Black, Executive Vice President at Colliers, and Ben Farr, Director of Development at the Fallon Company. Hi, everyone. So just as a reminder to those who are joining us, the Q&A is available on the bottom bar on Zoom. We'll be answering all your questions at the end of the panel. So feel free to enter them in there, and I'll go through them as time goes on. So I guess first, Steve, if you want to get us started here, you're our industrial guy. Industrial was a hot space pre-COVID. You kind of want to talk us through about how that's changed, if it's changed as a result of COVID?
Sure. And thanks, Andrew, for putting this all together. So industrial space in my marketplace, which is Greater Boston, is warehouse and distribution space, as well as what we call light manufacturing space. So think of medical devices, biotech, Cambridge coming out into the suburbs for space. So our marketplace industrial has always been very strong because of Cambridge and a lot of the manufacturing facilities that they need to have out in the suburbs. So pre-COVID, it was strong. Amazon was always, looking for space. We are one of the sectors that post-COVID has done very, very well. Amazon, I was just looking at one of our stats. Amazon has taken in, since March, when I think the COVID pandemic started, 10 million square feet of space in Massachusetts. So that's, let's see, almost 20 locations. So the Amazon effect, or the e-commerce effect, is very, very real. Everyone wants things faster, quicker, especially when they're sitting at home and working from home, can't go into the office, can't go to supermarkets or shopping. So the industrial market has been strong. Rents have actually increased in the COVID world. So it's been positive.
And you think that's going to continue for the short term and long term, or kind of what do you think outlook is?
Yeah, I mean, I think in Massachusetts, it's going to continue for a long period of time. A lot of developers are now looking for land sites in which they can buy the land and they can build industrial buildings on spec. Not even having a tenant that's committed to it, because whether it's Amazon that may take the space or other e-commerce groups, whether it be Wayfair, Walmarts of the world, Target's starting to get into that world, they all want to compete with Amazon. So I think it's going to definitely continue for at least another 12 to 24 months.
That's great. Yeah. And so I guess building off of that, what have you seen as kind of the biggest shifts in leasing as a result of COVID? Are people making any changes from their pre-existing, course of business of expanding? Or can you kind of touch upon that at all?
Yeah, no, I think what businesses are doing, again, people are trying to compete with Amazon. So we represent a large company that I can't share that's a competitor, that they're trying to expand their business to keep up with them, which before they were just, plugging along. So they're trying to keep up with Amazon. And some of the other, tenants that, if you think about it, when you're sitting at home and you can't necessarily go to the grocery store, out the grocers of the world, they're looking for space. The home improvement companies, you want to make improvements to your home, they're looking for space. Lowe's, Home Depot, cabinet companies. So the COVID situation hasn't slowed down some of these larger distribution companies.
Interesting. So I think maybe to shift gears a little bit, because in addition to industrial, you talk about you work with office tenants. Do you want to kind of shed some light on conversations you're having with office tenants looking to relocate kind of from the city into your area of the world, or area outside of Boston?
Yeah. So again, I'm suburban leasing in the Boston area. That's slowed dramatically. So everyone is comfortable potentially working from home if business is going well, so they don't need space. So we're seeing a lot of our clients looking to sublease space. A lot of our clients asking us to call landlords to say, can we get rent relief on our space? So the office world is being greatly affected by the pandemic. That presents at times opportunities for tenants that may be growing, and the Facebooks of the world are actually taking up more and more office space. Presents opportunities for them to capitalize on lower rents. But in suburban Boston, I know Carolyn will touch on this, we've been affected drastically in the office market. People are trying to sublease, and I don't see that slowing down anytime soon. People seem comfortable working from home.
Right. Yeah, that's kind of what my next question is. Like, hypothetically, we get a vaccine sometime in the future, right? Do you think, with the vaccine in hand, do you think people are going to be wanting to leave home, going to work in an office, but maybe not commuting all the way back into the city, staying in the suburbs in a suburban office environment?
Selfishly, I hope so. As a downtown office broker, those guys, I think they're being affected a lot more than we are in the suburbs, because people don't want to take public transportation and be close to folks going in there. They don't want to be going up an elevator 15, 20, 25 floors. So I hope selfishly that people realize they want to be in suburban offices. But me personally, I miss the structure of going into the office. I mean, Colliers just started to allow people to go in. I think it's very, very important, especially in a sales environment, that you're around your colleagues. So I hope the vaccine happens. I hope, things change, because I think it is important to be around people for a multitude of reasons. I hope people don't get too comfortable working from Zoom, working from home. As I'm sitting in a car right now on a Zoom, it's not that fun. So. I've been back in the office since around June. I'm in the office right now, and I can say there's a lot of benefits to being in the office. Getting back in that routine, I feel more productive and more satisfied with the work I'm doing, I guess. But all good points. Thanks, Steve. I think kind of to piggyback off you, Carolyn, if you kind of want to try to continue that conversation, talking about tenants looking for, office space outside the city. I've read quite a few headlines of, everyone's fleeing the city, they're moving to the suburbs, et cetera. Are you seeing tenants making that same sort of drastic switch in how their office setup is coming from the city to the suburbs?
So the short answer is no, it's not as drastic that I've seen. Downtown tenants looking to go to the suburbs at this point, for just a few reasons, mostly being that there is nobody's in their office right now. So they're kind of, the conversations are completely on hold. We've had some tenants inquiring and exploring options and kind of understanding what's outside of downtown Boston. But what Steve was mentioning, as the sublease market gets flooded, I think we might see, once we start seeing some movement in tenants actually touring, we might see some of these things, these kind of rumors start coming to fruition. But right now, there's just not enough activity to back up that claim that people are, these historically downtown tenants are rushing to the suburbs. Yeah.
And that's definitely one of the biggest question marks, that's going to exist for a period of time, hopefully not too long after things kind of settle down and get back to normal. So I guess maybe would you be able to give some perspective on, what the landlords, the conversations you're having with landlords, how they're reacting, any changes they're making, sessions.
So the biggest thing for our landlords right now is just retaining and renewing tenants. Where landlords might not have been as eager to do short-term renewals, they are very eager to have that conversation right now. Specifically in office, obviously Steve's talking about a market. If you're not some sort of industrial or life science, you are not in the office, and we've seen occupancy go down below 10% for the last 6 months. I think it's back up to about maybe 15% across all of our listings. So the biggest game plan now has been to just retain and renew tenants, work with them to try to encourage them to sign longer leases and give them concessions in that way. Depending on the landlord, we're not seeing a lot of rents drastically dropping, but we are seeing an influx in that tenant concession package, be that improvement dollars or free rent.
Yeah, I was saying, so are they giving a couple months free rent up front and then making it up in the back end?
Yeah, okay. Generally that's how it's structured. They try to avoid giving free rent inside of the term. So if you 2-year lease and you have free rent, that'll just be kind of tacked on. Your term will be tacked on to the end of the lease. Yeah.
Okay. That makes sense. And what have you, in conversations again that you're having with the landlords, are they talking about operating expenses at all? What are their concerns with that? Because I'm going into the office every day and there are hundreds of Purell hand sanitizers, cleaning staff is everywhere, which is great and you feel good, but I imagine someone's paying for that, right?
Yeah, no, and obviously that. So what happened was, yes, there is more, there's different costs now because everybody has this PPE and all offices kind of have these maybe extra staff, extra stations, to just direct traffic, especially if you're in a downtown building. There's a lot more staff directing you, so you can only use certain entrances. But every property manager that I've spoken to, and every call I've been on with our landlords, the underwriting actually went way down in the beginning of COVID because the buildings were simply not occupied.
Yeah,
they're back up to about 20%. Their costs, generally speaking, are still down just because there's cleaning happening and it's happening every day. It's just not the same extent as it was because there's nobody in the office. They're billing, tenants are getting things, rent credit or cleaning credits back if their offices are completely shuttered since paying for that use. So what the plan is now to kind of conserve any spikes for either the down cost now for the operating and what might go up. When we come back to work, they're underwriting everything. Their projections and budgets are all assuming a 95% occupied building. So that way they have the ability to bill back, to kind of give back to tenants if the operating cost is drastically lower.
Yeah.
Them if for some reason it does spike again.
Yeah, what I'm kind of thinking is we get the vaccine, people are going back into the office. Now you have, close to full occupancy and you have to deal with, the cleaning aspect, the other operating expenses that you weren't concerned about.
The cleaning is something interesting, as I was actually at a conversation just recently about this. It's done every day anyway. So anything that's added once people are back in the office, it's going to be sort of adding another just layer of cleaning where maybe they only did the surface cleaning once a week prior. They'll go in now, maybe do it every day or in the mornings rather than the evenings. So I think the cost is still there and it's still being accounted for. Now they're all just sort of, nobody really knows when the offices will be back to anything above 50%. So they're sort of just making the assumptions based on a 95% occupied building, and then they'll adjust as we kind of can see the end of this, whenever that may be.
Interesting. Yeah, that's really helpful insight. I guess my last question for you is what do you think the lasting impact of COVID is going to be in suburban office space?
So I heard this from someone else on another panel that I was on. I liked it a lot, and it's just this is just a moment in time. I think that's something that we all kind of have to remember. I think companies are likely to become more flexible in the future when it comes to allowing remote work, where people might have had not an option at all before. I think there might be some sort of a hybrid coming back. I think Steve said it earlier. I don't see offices going away. I think that there's going to be an inherent need for an office location, team building a company culture. I just don't see that really going completely away in this. That the short answer is if we get a vaccine, I think it'll be, I think we'll be back to some resembling normalcy after that.
Yeah.
So
Thanks.
I don't see the lasting impact for commercial real estate in general, downtown nor suburban.
Yeah. Thank you, Carolyn. That really helpful insight. I appreciate it. Now we're going to kind of shift gears a little bit to the capital market side. Jeff's our guy here. So I guess so kicking things off on your end, let's kind of take a macro view of what you're seeing in the market nationally. What are you seeing from debt and equity providers as a result of COVID?
Loaded question, but happy to address it.
Less than 30 minutes. So
Yeah. So I obviously sit in the Boston office, but I actually run the debt and equity practice for Colliers nationally. So we have some pretty good oversight in terms of the marketplaces, including areas like Nashville that Ben can touch on. But it's interesting to put it into context of where Boston is positioned relative to the national scope. I think you have to take, first of all, you almost have to approach my answer to that in really almost 90-day tranches of answers since COVID began. That's how much the market has evolved. There was the initial, call it shock and awe of the first 30 days, if you will. The market ceased to exist, period. End of story. There was no market of any kind in any respect, equity, debt, period, end of story. You saw an enormous retrenchment from the banking community, large and small, regional, super regional, national. There was no banking activity to be heard of for the first 30, 45 days because all these firms were inundated with the PPP Act and focused on putting that capital to work. The ugly secret behind it is banks made 5 points on every PPP loan. They made enormous profits. For context, the average origination fee on a construction loan for a bank is between 50 and 75 basis points. So they're getting between 5 and 10x the fees in a 30-day period. So there was nobody picking up the phone in short order. The good news is what we saw was the ripple effect of that was multitude of effects, but really what you saw was the emergence of the past 36 to 60 months of debt funds, which is private capital providers, typically historically LP and equity capital providers who have positioned themselves for defensive positions in the debt capital stack to originate or construction loans or what have you in the debt space. Probably 2/3 of those groups relied on leveraging their positions, meaning let's say they raise $1 billion debt fund, okay? They could put $3 billion of that on the street through leverage, meaning they're borrowing against that $1 billion fund through subscription lines, warehouse lines for banks, any other type of mechanism. All of those warehouse lines and credit lines got pulled by the national banks in COVID. So we've probably seen half the debt fund cease to exist since COVID began. It had to happen. They were becoming a dime a dozen. So what we've seen is the return of cash is truly king. The existence of a proprietary and discretionary balance sheet is enormous right now. It's allowed groups to pick their spots. But really what we've seen, I'll say the downturn in terms of lack of activity wasn't as pronounced or as long as I would have thought it would have been if you asked me in the middle of April. Couple things that have kept the markets humming along is the Fannie Mae and Freddie Mac, the agency space. The amount of capital flooding into that sector has actually caused cap rates on multifamily to compress beyond pre-COVID levels. So we're seeing assets trade in St. Louis, Kansas City at 4 and 4.5 caps, and whether it's value add or stabilized, it almost doesn't matter. And the rationale for that is I just priced a $80 million deal an hour ago, and the client can borrow 75% of the purchase price for 10 years at 2.4% fixed. So it's not hard to follow the math. I mean, if you're paying a 4% cap rate for an asset and you can borrow at 2.4, it works all day long. So the Feds have been buying all of that Fannie Mae and Freddie Mac paper, which is what's kept yields so compressed in that space. So that's kept the apartment space intact. The way that the agencies and life companies and others have responded to COVID, however, is we're seeing them require principal and interest reserves, literally defined as COVID reserves, at closing. And it's based on where you are in the leverage stack and, how well the debt covers that, through cash flow. But typically you're seeing 12 months of principal and interest held back at closing in a lockbox, and it's inaccessible to the borrower, except for it's literally there to anticipate a collapse in cash flow due to the peel off of PPP and all these other CARES Act stimulus situations. So long story short, that space, the multi-residential space, has continued to kind of cruise along. It's a safe harbor asset. Industrial has been a safe harbor asset. It's the best performing asset class in the world right now. Has the lowest delinquency rate. It's 98.9% current through COVID in terms of rent collections. It's the most, it's as close to a fortress as you get. Although I would say in the Boston market, lab and life science is toe to toe right now, I would argue, with industrial in terms of the most defensive asset class. Talking about what Carolyn and Steve were saying, if you look at, the Boston office market is between 5 and 15% occupied at any given point in time right now. The lab market is 100%. It just has to be by virtue of what they do. Canary in the coal mine, however, in the lab space is there's 31 million square feet of lab in the current pipeline between now and 2024. That's more than exists in all of Massachusetts today. So it's, people are chasing that trend for a reason, but we're encouraging, make your money in the next 24 months in that space is kind of, what we're suggesting. Kind of talk about what we're seeing in the investor space throughout COVID is we initially, we took a project out in the middle of March against all my better judgment, but we had to based on a closing timeline. And this was a ground up apartment deal. And this speaks to a number of trends that I think we're seeing is this was a 475 unit apartment property in Marlborough, Massachusetts. So one of Steve's markets that he's playing in out there. The Marlborough Framingham 495 corridor, even 24 and 36 months ago, was perceived to be a relative backwater and not institutional. That's almost flipped entirely on its head, I would argue. You're seeing enormous lab clusters emerging out there. There's a hub and spoke concept where the lab companies and CRISPRs of the world are developing Class A trophy facilities in the Seaport District and consolidating all their disparate office spaces into one flagship lab space downtown. And then they have the biomanufacturing and the GMP facility. GMP is literally the last mile industrial, but applied to lab. So it's where the actual production of these novel sciences are created. And that's not a particularly accretive asset type to have downtown. And that's going to drive people out into the suburbs. So what we found capitalizing this apartment project in 495 was we ended up doing it with Rockpoint Group, the largest landlord in Boston, who had never invested outside of even 128 in Waltham, yet they're headquartered in Boston. And what they saw there was this flight to the suburbs in terms of residential base. I would probably tend to agree with Carolyn about the urban core for office, but in terms of residential, it is happening. You have 6,500 apartments empty in Boston as we speak in the urban core, and yet the suburban assets are, it's historically high occupancy rates, and we actually have clients who are pushing rents in the suburbs. And what we saw, the way that investors responded initially to that was some are actually, again, I don't want to go down a rabbit hole, but I can, but what we saw a couple investors focus on was the concept of an IRR, internal rate of return look back in the capital stack with the developer partner. Effectively, it's a guarantee of a minimum return. That's not something that's existed ever, but that's how some groups responded, and it's effectively what allowed some of these projects to proceed. Andrew, you got to stop me. I could keep going.
No, it's all right. No. This is all good stuff. I know I gave you the hardest question probably on the panel. So. It's good, Jeff. I just want to take a minute to acknowledge Sylvia Maxfield. She was just on. She might have stepped off. She'll pop in. Dean of Providence College School of Business, has been a big supporter of us in the real estate world, and will always be an advocate. So thanks for joining us, Sylvia.
Yeah, agreed.
I'm here, and I'm seeing that the host has done something to my video. So
there
now
you
I'm
are.
back. Sorry I was late jumping on.
That's all good. Thanks for
You
coming.
guys are awesome. You guys
So,
make me so incredibly
yeah.
proud.
Andrew, if you
being
want to
in a
have
business
Ben and
school.
I just tag team it to kind of mix it up a little, happy to do that. And him and I can just jump in, and Steve and Carolyn, feel free to do the same if you want. But if you, Andrew, if there's anything, I'm looking at the 4 bullet points here. Is there anything you want me to hit on specifically?
Yeah, well, maybe this is something that kind of you and Ben can tag team. You know, talking about the development pipeline, how that's been impacted with COVID. You know, but maybe talk about Boston, talk about Nashville, which is Ben's market. You know, any light you can shed on that?
So yeah, Ben, I'm going to tee this up for you. I would argue what we're seeing is an enormous pivot away from the gateways, meaning the global 24/7 gateways, to what I'll call the secondary cities of the Nashvilles, Austin's a gateway, I guess, but not these global coastal gateways, if you will. So Sunbelt, Mid-Atlantic, you know, the Richmond, Virginias of the world are on absolute fire right now. And, you know, what we're seeing is a real pivot to these marketplaces. I do think COVID has resulted in a generational opportunity for people to sit back and determine if they're happy with the way they're living their life and the taxes they pay and the lifestyle they lead. And it's a chance to course correct. I literally have friends who told me last night they're selling their home in Hingham, Mass, and moving out to Williamstown in the Berkshires because they're just like, screw it. He's a partner at Ropes and Gray, and they're going to let him work remote. You know, I would love to move to Nashville, but I'm too entrenched here. But you know, there's a cost. There's a real trend at play, and that was happening even pre-COVID. But you know, we're even seeing it on a more micro market basis locally in New England, where the Portland and you know, broader markets of Maine are, even on the New York Post today, said the market in Maine is going gangbusters with transplants from New York City who are fed up with COVID in New York and are taking this chance to kind of course correct. So I think that's been happening for Nashville for a long time. I think people are understanding the allure of that city, and it's finally getting the employment base to back it up. Ben, you can probably confirm a lot of that.
I'd completely agree. And it goes to what you were mentioning with what's going on in Boston and the surrounding area right now. Is lab and life science and industrial are all really strong. In Nashville, it's different. You don't have that lab, life science, industrial backbone to really hold everything stable, but what you do have is a booming population. The number of people moving here every day and the number of jobs that are being created by corporate relocations, right? Like you said, Jeff, people are moving down from those gateway cities to the Nashville area, and a lot of them are senior executive members of these companies saying, well, why don't we look at not only the benefit for our employees and the cost of living, but also the cost of doing business. It's a very business-friendly environment down here. And that's part of why, as a company, we've decided to move down and start an office as well. On top of not only what's going on with the strong fundamentals of Nashville, where it is driven by, I'd say, financial services, you got technology, you got some large healthcare companies, 20+ secondary education, universities and colleges in the area. And then a huge one is, the majority of people who are on this call probably know, tourism. There are so many people coming to town, whether it's a bachelor or bachelorette party, or you're coming for a concert, or you're coming for the historical background of the Nashville area, or even if you're just coming to see the sports teams that they have, right? So there's a lot of reasons that people are coming down, and on top of that, it is nice sometimes this will be my first warm winter of my life. I grew up in Western Canada, freezing cold, moved down to Boston and Rhode Island, a little warmer, and now it feels like I've made it. Now that I put shorts on today for the first time, I think, ever in my life in October. So it's a good combination down here, and it is supported by what's going on in the business community as well.
I guess kind of how's that, has your outlook changed at all development wise, Ben, of, with these trends? Are you guys more aggressive than you were pre-COVID? Has COVID slowed down kind of your expectations of growth or somewhere in the middle?
Yeah, so I think what COVID has done is sort of pointed out the oversupply that's going to be coming online in a couple of different areas in Nashville. So since 2020, there's 21 hotels either under construction or have been delivered. So you're talking over 4,000 keys, right? So you have so much supply coming online and there's no one coming to town anymore to use it. You don't have the tourism. You aren't able to have the conventions. They have a huge new convention center downtown. So all of that is going to be hurt pretty badly because that's still likely going to be continuing for a little while. So that's something that we definitely have recognized and wouldn't be breaking ground on. That along with retail, it's just tough to sort of feel out what is the retail environment going to be in the future. And as a company, we've primarily focused on doing large mixed use developments, right? So we're looking for, let's call it 5+ acres, which in and around Boston, you can't really find that. And then if you do, the price of the dirt is so high that you can't justify really building anything than a tower or something that's of a luxury brand. So down in Nashville, there are quite a few large parcels available. You've seen, and I might actually just share my screen quickly to show what is going on in terms of the amount of development that's taking place. And so hopefully you can see this.
Yep, we see it.
This is all planned, proposed, or under construction projects in Nashville right now. And so this is just the downtown core. So for anyone who's been here, this is Broadway, right here where you'd be for the bars and the majority of the country music. You have the Titans Stadium, which is right on the edge of downtown. But what you're seeing in a lot of these areas is still industrial use or undeveloped land. And you're getting a lot of infill, let's call them half an acre, maybe an acre projects, aside from just a couple big ones that are being master planned. And it provides that opportunity that you can't find in the gateway cities, like we've discussed already. So it is an opportunity for a firm like ours where we're looking to plan and design a neighborhood and control the built environment. And so that allows us the flexibility, Andrew, to have the different uses and to have the right timing with planning out our developments and making it through difficult times like COVID has presented.
Yeah, well, maybe could you touch a little bit upon, and maybe Jeff, you can jump in here, kind of talking about how you're capitalizing projects going forward. Are you getting, have your investors or banking partners, gotten concerned at all as a result of COVID, as a result of Nashville and, maybe it's oversupply coming to market? I don't know, maybe both of you can kind of tag team that.
Yeah, Jeff, you go ahead if you want.
Yeah, I'll touch it quick and then you can speak to specifically what you're seeing. I think it's the cliche thing to say, but it's really deal by deal. But I think at a high level, and if you're doing housing or mixed use, typically the way that those projects are capitalized is someone like Fallon Companies, Ben's firm, will bring on an institutional limited partner, LP, to be his joint venture partner on the project. His firm might contribute anywhere from 5 to 25% of the required equity, and the partner would bring the lion's share, and the developer partner would take developer fees and then earn what's defined as a promote through a waterfall structure, where the higher the return to the LP investor, the higher the developer's share of the deal. So effectively, it might be 8 to 10% preferred return to everybody in accordance with their share that they've invested in the project. And then as you approach, call it a 17 return to the investor, Ben's firm might take half of the remaining profit after that, or even 60% of it, depending on that. That's why they call it a waterfall. So really whatever's remaining after each tier, it spills down into the next and gets divvied up. That's, again, it's based upon project size, but it's groups like, Mass Mutual, AIG, New York Life, who are, life insurance companies who are more institutional, but it's family offices, it's Goldman Sachs, private accounts, it's Northwestern Mutual, it's any number of vehicles. I think what saved the market, honestly, is at the tail end of 2019, there was almost 300 billion of liquid cash allocated to domestic U.S. real estate on the sidelines that hadn't yet been deployed. And then the first quarter of 2020 was the highest record-breaking fundraise ever for a quarter. So there's an enormous amount of pent-up demand and cash just on the sidelines that's got to be deployed. And in terms of, like a group like Nuveen, which is the rebranded version of Teachers Insurance, they just came out and said they're adjusting their allocations for next year to real estate by up to 30% higher than last year. So there's a part of that just because people had a hard time putting money on the street this year. So there's a bunch of liquidity on the sidelines. In the debt space, capitalizing projects, people are going to turn the screws and really get under the hood and really question assumptions. I think in terms of the lending community and in terms of the investor community, I think one thing is consistent. People will really give you a side eye if you're going to project residential rent growth over the next 12 to 36 months. They're going to really make you justify it. So projects can get capitalized. There's probably more of a pivot to build to core, meaning less focus on merchant build, and you're building for a long-term hold with somebody. That seems to be becoming more in fashion with investors that we're seeing. Ben, I'll kick it to you on that front, but you can still get projects done. I would say, hospitality, no surprise, would be incredibly difficult. We actually had a client in downtown Boston who had all his approvals for a hotel project. And I had the exclusive to do it. And I looked him in the eye. I'm like, we both know we can't do this project. And we're now valuing the dirt for a lab development, and he'll probably make 5 times more money just selling the dirt for lab. So, Ben, I'll punt it over to you. But
that was well said, though. I'm glad this is recorded. I'm just going to use that little 2 minutes for all our new hires. pass this along. Listen to Jeff. But yeah, well said. And I think just on it's project by project, and what we're seeing, what we're doing right now in terms of our construction, we have 2 offices that are coming out of the ground, but it's substantial pre-lease has been a huge driver, right? There needs to be some sort of security with not knowing what's going on in the office market. Residential, with people sort of fleeing the downtown urban locations, which is primarily what we do for development in terms of where we're trying to be within a city. You need to look at that stuff. So it's the suburban residential. Yeah, it makes sense. There's even, like, I can't remember who mentioned it, but driving rent growth right now. But downtown, it is very different. So with our office buildings, we've been lucky enough to have a couple large pre-leases in order to get going, and it's been a somewhat normal process, but I would say there's significantly more due diligence being done on all parties' sides before anything's finalized.
Yeah, I think definitely people want security, but they feel confident that this is going to pass, is kind of like what I'm picking up on, and the things that I'm hearing too when speaking with the banks. Carolyn, I want to ask you a question.
On that thought, what I'll tell, and Ben, you can steal this too, but whenever I'm trying to pitch someone on investing in a ground up deal that we're running with, I try to remind them, I'm like, you got to take a step back. Remember, whenever you're building anything, you're always building into the unknown. And how could the future unknown be any worse than today?
I like that. I like that. I think it too.
Yeah, a big part of it is construction timeline. Looking at exactly that, when is it coming online, right? So realistically, if you're buying dirt right now, you're 2 years out. So are you building into a growing economy, or are we still sort of flatlined with where we are right now? So it's something that we get a lot of questions about at every project we're working on. Yeah. And with just on the construction side, real quick, just with the supply chain interruptions and the issues and changes, even we're looking at pricing a stick-built residential in we have an office in Charlotte as well, and the price of the lumber went up over 50% since COVID started. Yeah. So it almost changed what building materials do you use now? It almost makes sense do we even start to consider like a modular construction? Is it something that can control the timeline a little better? So there are a lot of questions that are coming from that side, but in terms of the overall discussion, what we've been talking about so far, I think it is when are you going to deliver? How confident are you in your supply chain and being able to finance based on that?
Yeah, that's good info. Carolyn, just a question that popped up in the chat, and I think that could be related to kind of what we're talking about, generally the office market, kind of seeing how the WeWorks of the world, what's going to happen with them. I work in a WeWork, and I can tell you that there's not a single other person in this office other than me and my coworker. Carolyn, I didn't know if you had any interaction with WeWorks in the markets you're in.
So I honestly think that there's just so much unknown. I think that when we come back to the office, there is, as Jeff and Ben were speaking to, and I did it myself this summer, people are kind of leaving the city and trying to find alternate, locations to live, reevaluating their importance, like their work-life structure that they were kind of making do before. Now they have all this extra time, maybe getting to know their kids for the first time. I don't know how busy people are. I think that WeWork the thing that might keep WeWork around, or WeWork type concept around, maybe not WeWork by that name, is that if the push to the suburbs does happen, I think that people who live and work in the city are more likely to pop in if you need an office space, if you need a place to go to work, if you have to be productive. I know not everybody, but most people are that I talk to are definitely more productive in an office environment, regardless of whether you're alone in a WeWork or if you're a bustling office, just than you are in your bedroom or home office or whatever, however else you're making ends meet. So I think that if they can adjust to this, obviously we've seen the trend in office go from perimeter offices, everybody in their own private space, to wide open, no offices. And I think that we all realized immediately that was a pretty bad idea, and we're kind of going towards sort of a hybrid. So I think if WeWork or WeWork type concepts can evolve with the needs that people have now, which is more of like a semi-private or something that has, a little bit more feeling of security. You're not just sitting out sharing at a table with somebody. There's definitely going to be a need for that, especially when people are kind of going back. Maybe their offices locations have changed and they're kind of going back part-time, both in the suburbs and in downtown.
Yeah, I think that's completely accurate. I agree kind of with what your outlook is. Ben, I don't know if you're seeing kind of similar sorts of trends of people, not being in the office in Nashville. Are there many kind of differences that you've noticed coming from a Boston market to the Nashville market that you might be able to kind of shed some light on and give some comparisons for us?
Yeah, so in terms of just general life, we're looking at that. The office, or people being in the office, still seems in line with what's going on in Boston.
Okay.
There's not many people going in. I've been trying to do a couple office tours to solidify which building we're going to end up in. They're empty when we walk through them. There's nobody in there. Yeah. But if you go out to a restaurant or a bar here, it's packed and nobody has masks on. Like our neighbors, when we moved in, all my neighbors have come up and shook my hand. It's the first time I've shook anyone's hand in 7 months. So it's a very different approach to how to handle COVID, I guess, or how the state itself is treating it. So you're seeing that, and even look at what happened with the Tennessee Titans, right? The first football team to have COVID and 20 plus members of the staff. And I'm not surprised really based on what I'm seeing in just the day-to-day activities of residents. So that side of it, I think you can probably go, and I haven't traveled much during COVID. I've been in Boston, I've been here, but I'm assuming some other markets may show similar trends where the everyday life is handled differently than it is in Boston. So in terms of the COVID impact of the business core, I think it has been affected in a serious way, and people have done that work from home and have enjoyed the opportunity to have a little better work-life balance, even though the commute down here is probably half or a third of what some of the major markets are. People are still enjoying to work from home. So I don't even know if I answered your question on that one.
No,
but I got distracted on
what
I've
I think it's
seen.
helpful because I think most, if not everyone on this panel and who's joining today is kind of in the Northeast corridor, and obviously not being able to travel, it's hard to know what exactly is happening out there, like in real time. You can talk to family and friends, but I think it's good for you, someone who's lived here for a while, now moving to Nashville, to kind of give those comparisons, especially like going into an office, going to an office tour and not seeing a single other person, right?
Right. But then still, if you walk past Broadway, it's pretty busy. There's still a lot of tourism going on. They're still trying to keep And it comes down to the struggles of retail. They've paid so much over the last few years to buy those existing buildings, renovate, fix them, get a celebrity, put their name on the side of it, and then they need to be open, right? They have mortgages, they have debt that needs to be paid, and they're not making any money unless their bars are open. So it's a tricky balance, which I feel the state and local governments down here have taken a very different approach than what Boston has.
Yeah, I've got a couple questions in here regarding retail. Ben, you kind of touched upon retail a little bit, but maybe Jeff, I'm not sure if this kind of gets within your scope, but do you have any outlook kind of on retail going forward? And what I've seen in the market that, the retail with grocery anchor tenants, those strip malls have done well. The others have struggled. Do you have any insight that you could share with us?
Yeah, core, ultra core grocery anchored it is actually still pretty liquid, and you can still capitalize it. But you've got to have top 3, top 4, ideally top 3 grocer in terms of market share for that specific region as your anchor. It's got to be neighborhood focused in terms of like a conventional neighborhood center. Lifestyle properties are getting their butts kicked right now. That's the weakest space, unless you're anchored by like a Whole Foods like Derby Street and Hingham. But Hingham Shipyard, locally here in Hingham, is getting decimated. And that's that's what'll be interesting is how long can a lot of these. It's so funny that transit-oriented development was the leading edge, development play for so long. And, a place like Hingham Shipyard that relies on 2,000 people parking their cars there every morning and taking the ferry into the city. It's a 30-acre empty parking lot right now for the past 7 months. And I mean, everyone's folding in that area. And it's because they've got no true draw, no true anchor. They got a Bed Bath & Beyond next to 5 local restaurants. I mean, if you're going to Bed Bath, you're not also getting a taco. It's like, it's so the core retail's doing okay. I'll tell you what's not attractive to anybody right now is the bigger, broader, super regional centers where, we're actually working on Ben, actually, we should chat, but we're working on a repositioning of a property in Memphis, Tennessee. It's anchored by a Kroger, but it's a big sprawling, it's one of those big, 50-year-old, it's been around for years, but right in the middle of it, it's got a 40,000 foot K&G menswear store. Like, I mean, I don't even know if people will wear suits coming out of this. I'm not even joking, but I mean, aside from like a seminar or something, but like, and that's part of Tailored Brands, which is Men's Wearhouse, Joseph Bank. They went BK, and now you've got 40,000 feet, and then it's the areas with the big box exposure. People don't want access to that. It's just that's going to be the big challenge. But then you're seeing. There's an asset locally up on Route 1 in outside Boston, and Carolyn and Steve and Ben will know that the tenant who shall not be named. I think we all know who the tenant typically is, but it's but you're getting these situations where Amazon is coming in and taking over old Sears boxes suddenly you're thinking that this property is on its knees, and then you get Amazon IG credit for 30 years at double the rent. So that'll be interesting to watch. I don't know if Carolyn or Ben, what you're seeing in your space, but it's certainly a difficult. It's really case by case.
You guys have anything to add or?
I just think, there's going to be a whole shift it's almost going to look like a new Boston when this is over, with the amount of shuttered stores downtown and the way things are going.
Yeah.
Specifically in the hospitality and restaurant group. I think, in the Seaport, you're seeing like a lot of specialized retailers that are Instagram first or like social media first, and they're kind of setting up the brick and mortar, so they seem to be doing okay because you can physically still go in the stores without worry. But like it's just not the. I think Boylston Street is going to look completely different. There's going to be it's just going to be very interesting to see what comes out of it. I think we've all been around enough to know that I don't think the city and downtown concept is going anywhere once this is over and behind us. I am a city girl. I grew up in Manhattan, so I actually was getting really offended when people are saying New York City was dead, but I just think it's going to change, and it's going to change, you know, some things will change for the better. Some things, you know, I think it'll just take some time before people feel comfortable again, but this is a moment in time, and I think our memories at the end of the day are a little bit short. So I think that, you know, the city urban centers are not going to really go anywhere.
I agree.
I think it'll change. The look of it will change, and the look of your day-to-day work will change, but I don't see it ending.
Yeah, no, for sure.
Yeah, Carolyn, I would argue it could be the reset that a place like Boston needs.
Needed, yeah.
With respect to, like, I mean, Newbury was becoming a chain mall.
Yeah.
And, you know, this you could argue this opens up the return of cutting edge mom and pops and local upstarts and boutiques and local restaurants, and getting rid of the chain.
Sort of what Newbury was 10 years ago.
Yeah. And, you know, I guess the devil's advocate against that theory is the people who own these assets need $1,000 a foot to get the returns that they paid
Right.
for.
I mean, I don't work in the retail space nearly enough, but I'm sure that there's going to be a lot of creative ways to try to get some you know, local companies back involved in the conversation. Since those are, to steal off what you were saying earlier, those are truly a deal by deal basis. So it'll be interesting to see. And like you said, I think this might have been a reset. Everybody kind of like lost locations and restaurants and bars and shops that they loved. But I think that this is a time where everybody's kind of resetting their own life and work structure, and we'll see kind of what comes out at the other end.
That's great. Ben, you have any other final words for us or thoughts just about COVID and how sick and tired everyone is of it?
Yeah, and I don't know. I'll let everyone else chime in on this too, but it's especially with retail and especially with hospitality, and I think some of the other uses like office will continue to see some issues when it comes into long-term planning when you have the ability to. But we're still a ways off from the vaccine, right? So talking about how Newbury is going to be reshaped. What is going to continue to happen with the troubles that we're already seeing in the market? So how do those be sustained? How do we adapt, and how do we find ways to not have everyone shuttering up so that when we come out of this, it's not another huge delay before we are back to, let's say what is close to normal life before COVID hit. So I think there's difficult times ahead, and especially in the real estate sector, and I think the majority of the uses.
That's great. Sylvia, if you want, I don't know if you want to say anything here. I think we're kind of nearing the end of our really great conversation. Thank you again for joining us.
I hope I wasn't formally supposed to say anything at the beginning.
Eh.
Were you looking for me at the beginning?
No.
Awesome, good. I just put in the chat. The content was excellent. I've been busy texting various family members that have worked with private equity firms or whatever. The price of lumber in Austin going up 50% since COVID started is kind of a very interesting fact. So proud that you all are PC alums, and I put in the chat, you're excellent communicators.
On the cost of lumber in Metro Boston, it's up 240%.
Are you kidding me?
240. I don't know the specific phrase, but let's just say by the bushel.
Wait a minute. How does that happen? Like, I just don't get it. There's big supply chain disruption. Is that just all supply chain disruption?
It's supply chain. It's twofold. It's supply chain. Well, it's threefold. It's supply chain, number one. Number two, the lumber forests are burning to the ground right now. And number three,
Okay.
the trucking companies don't want to carry lumber because they're getting paid more by the grocery and Amazons of the world. So you almost have to bribe the trucking companies to get there. And, just for context, again, it's not called a bushel, but I don't know what the phrase is, but the historical mean average for a bushel of lumber was in the $350 range. It spiked up to almost 1,000 in the past 30 days. It's come back down into the 700s, but it's exploded in a big way. So it sounds like the Southeast is faring a little bit better, but in the Northeast, that's the real world implications. So.
That is mind-boggling. So we're going to be building with everything but lumber going forward, it sounds like.
It'll be a mix.
Yeah.
And just to add a fourth, it's with everyone at home, everyone started doing home projects. The
Right.
amount of work being done on residences and new construction with everyone moving out of the gateway cities, it's amazing how much it has changed the industry.
Yep, that's spot on, Ben. Yeah, I think that's a good point. It's being driven by the single family housing market as well. Yeah, huge.
Everyone's home staring at their things they should have been fixing for months.
I had an architect here this morning.
See? Thanks, Jeff. All right, I think.
Okay, go ahead.
Yeah. I think that's it for everyone. I really appreciate, Ben, Jeff, Carolyn, and Steve who had to hop. I really appreciate all your time. And thank you everyone for joining us. I think this is a really great conversation, really productive, answering a lot of the questions that I know that a lot of people have. Hopefully we hit them. If not, we're able to get the Q&A after the fact and can reach out to you separately if it's appropriate.
Andrew, one before we jump off, it seems like a couple of people were asking how to join the alumni real estate group.
Yeah, sure. So, so this is, I don't know if anyone caught it at the beginning. It's a group that I started and have kind of expanded in Boston. I've started a committee to kind of give some formal structure to the group. Jeff, Ben, Carolyn, Steve, and a whole number of people are all members of it. It's something that I wanted to do in the Boston area to have a way for PC alumni to come together and network. We have a lot in common. And I can tell you the events that we hosted pre-COVID were extremely successful and really productive. Myself, I went to a lot of those big networking events and didn't get a lot out of them. I've made some really great friends in this group. I think other people have made really great friends. I bought my house from a broker that I met in this group. So there's also business deals happening. So I think that's a good thing. And if anyone's interested in joining, please reach out to me and I'll tell you what we can do. But yeah, thanks, Ben. All right, if that's it. Thank you very much, everyone. Again, have a great rest of your week. Have a good weekend.
Thanks, everybody.
Thank
Bye.
you.